He's invested $3.1 million across 17 companies. Today, our interview is with Tyler Tringas of Earnest Capital. But before all that investing, it all started in 2008 after he graduated college and got involved in the renewable energy sector. That led him to eventually launch his own company, which he wanted to go raise venture capital for. He pitched over 400 venture capitalists, and ultimately, after trying to build that company, it failed. They just couldn't get traction. So he shut it down, but in the process, followed his wife to San Francisco. And when she got a State Department job in Buenos Aires, they took that flight down there, and Tyler built the original MVP for his new company called StoreMapper on that flight. The company over the first 12 months went from nothing to $2,000 a month in revenue. He ultimately scaled this business, getting customers off Upwork, doing Shopify contracts, and grew it to $16,000 a month in revenue in 2016 before making the thing highly profitable. In fact, Tyler was taking over $250,000 out of the company as salary before he sold to Shore Swift Capital in 2017. The company was doing way more than 18K in MRR at that point. After the sale of Shore Swift, he said, you know what? I want to build a better way, more options for founders. And that's when he put pen to paper for Earnest Capital in 2018. He raised that $3.1 million fund from over 40 individual investors, has deployed that capital over the past 12 to 20 months into about 17 companies at an average check size of $150,000, and is now looking at raising his next fund, which he's invented a brand new model for quarterly subscriptions. It more closely matches how you build a SaaS company. Makes sense. He's doing it in an interesting model, a 506c. Enjoy today's interview with Tyler Tringas. Hello, everyone. My guest today is Tyler Tringas. If the name sounds familiar, it's because he blogs like nobody blogs before. He's building a company called Earnest Capital today, but historically, he's always been a prolific writer about all of his startup adventures, starting with renewable energies out of college, then eventually got into his own bootstrapped startup, which he ultimately shut down, and then another one called StoreMapper, started in 2012 and ultimately grew that before selling it. We'll jump into that story. Then got into a very hot space, which was Shopify for a couple of years before really going all in on Earnest Capital today, and another company he's still a builder behind the scenes, which I love, called Maptia. We'll touch on all those things today. Tyler, you ready to take us to the top?
Yeah, let's do it.
All right. So one of my favorite sort of quotes in terms of reading your stuff and prepping for this, you say, the new American dream is building, owning, and selling a software company. Tell me more about that.
Yeah, I think it's well, it really is. And I say the American dream, it's a rhetorical device. Obviously, this is a global phenomenon, but, the general idea of the American dream, right? The being successful, the white picket fence, all that sort of like just baseline level of success that many people aspire to, I think is really converging around the idea of running a profitable, remote-friendly software or technology-enabled company that essentially you can run from anywhere in the world, and it makes money while you sleep, and maybe one day you can sort of sell it for a life-changing amount of money, or maybe you just run it for the rest of your life. But I think really that kind of entrepreneurship is the American dream in a way that maybe a generation ago it might be very very job driven, right? Become an attorney, become a successful doctor, that sort of thing. Not that those are not important anymore, but I think the core thing that a lot of people aspire to, and I found it through my writing and through Twitter and stuff like that, is this running a successful online business.
Yep. And is this one of those things where it's just hyped and so everyone thinks they can do it? Or is it actually the new American dream? Can this actually be done by millions of people? Enough hard work, enough grit, you can build a profitable company that makes enough salary so you can live on?
Yeah, that's a great question and a great distinction. It is the American dream because I think it is also quite achievable, with all of the caveats that it is, harder for certain people than others, and it still takes a level of skill, and sometimes it takes a level of capital and a push to get there. It is one of the most permissionless paths to success, I think, that exists right now. You don't necessarily need a degree. You don't need to go through a rigorous hiring process. You typically don't need a ton of capital, at least to get started. A lot of times you can build it with what you can put on a credit card, month by month. The on-ramp is one of the most accessible in the economy. And on the other side of the equation, the number of opportunities, I think, is just dramatically multiplying. So it's not the case that, a handful of software companies are going to scoop up all of the opportunity. What we're seeing, and something that I've written about, is this new deployment age of software. Maybe we'll talk about that a bit later, but that essentially now these kinds of companies are getting into every little nook and cranny of the economy, and there's so many, opportunities that maybe are not $10 billion opportunities, but they're very viable ways to build a profitable, sustainable business for folks.
And let's not bury the lead before we jump into your backstory to learn about all your creds, how you grinded yourself, how you got to the idea of Earnest. Talk to us about where you are today. So I guess maybe the headline would be, what was the fund one size of Earnest, and how many companies did you invest in your first cohort?
Yeah, we launched Earnest. Well, we literally like first pen to paper or words on a pitch deck in August of 2018. 6 months later, so February of last year, we launched Earnest Fund 1. Candidly, it was really like a proof of concept fund. So it was about $3.1 million that we invested over 18 months. So it was essentially one company a month for 18 months. And we are just hitting the end of that. So we'll write our probably last 2 checks out of that. We've done 16 companies to date. We'll write our last 2 checks, over the next probably 6 weeks or so. And then we'll move on to our second fund, which is, basically in motion.
And guys, if this is the first time you're learning about Tyler and Earnest, they're doing it in a very neat, interesting way. We'll actually dive into the term sheet, which he's made public later on in the show. But with that sort of open loop, Tyler, let's jump back into you graduating college. What did you study in college, and why jump into renewable energy sector right after?
I studied economics in college, and I got into renewable energy. I was interested in it just academically. The energy markets, I think, are really fascinating, and I got sucked into a rabbit hole, as I'm sort of want to do at some point in college. And the opportunity or the moment when one needs to stop focusing on study abroad and start focusing on internships kind of arrived. So I started
hopefully paid internships, right?
Yeah, well, poorly paid is kind of how it worked out. But I ended up just stumbling upon, I kind of combined the two. I did this study abroad internship program in college. The University of Florida, where I went, had this kind of thing where you could go to London and you could take an internship and you could take classes, and I just sort of loaded up and took like all credits of internship. So I basically just worked full time and got to keep my scholarship money. And so I was in London, and I found this startup consultancy called New Energy Finance. They were like 20 to 30 people in London, and they were, you can think of them as like a pure play, like McKinsey, doing advisory services and data and all that sort of stuff, but totally focused on, at the time, the like really young but really rapidly growing clean tech market. So wind, solar, biofuels, carbon markets, that sort of thing. I just got an internship there, which turned out to be like my last ever job application of any sort.
Do you remember what you were paid? Do you remember what you were paid?
Yeah, it was, it was questionable. It was one of those things where it was in the time period where it was still okay to sort of have the idea of an unpaid internship as a decent sized company. And literally a couple of years later, there was a sort of crackdown on that. And in retrospect, it was probably not like 100%.
Let's say I asked the question and Tyler's face goes, I know what it is, but I probably shouldn't share this because it's going to get the company in trouble because it was so low. It probably wouldn't meet today's standards for acceptable.
The company has since been acquired by Bloomberg, and so I think everything is cool. But yeah, it was basically lunch money, and I couldn't have done it basically, where I was in life, especially in London, which was incredibly expensive, without the kind of hack of keeping my scholarship going for it. So that basically covered my cost of living, and I worked like effectively an unpaid internship, basically. Yeah.
The company was acquired by Bloomberg. Did you stay with Bloomberg or did you leave?
So I did the internship in London, and then basically I came back to finish my last semester of school, sort of emailed them again. I was like, that was fun. Can I keep working remotely? They said, yeah, cool, great. So then I was getting paid for my last semester, and basically it was a no-brainer when I finished school to work for them. We had already been working together, and they were just like, do you want to do this full time? And I said, great. And they were just opening up in the US. So they had like 2 people in New York and 2 people in DC. And I went to go join the team in DC there. And so that was pretty cool. It was kind of like real true startup, experience. Although they were a little further along as a company, it was, growing from 3 people to 7 people to 15 people kind of thing in that space. I stayed with them for a while. I worked for another 2 years at the startup. So I worked a year in DC and a year in New York, and then they were acquired by Bloomberg. And then I moved to London and continued working them for about another 18 months.
And what year was that? What year did you graduate?
I graduated in 2008. So,
okay, and worked with them until 2010?
Yeah, late 2010 is when I started to, maybe early 2011. Yeah, late 2010 to early 2011 is when I quit and decided basically that I wanted to be an entrepreneur. It was really my first foray into real entrepreneurship. Essentially, I saw a market opportunity. So I didn't come from a software background or anything like that, but one of the things I was doing there was a ton of modeling. So I wasn't a software developer, but I was doing Visual Basic and massive Excel models and stuff like that. And I was running the forecasting group, and I essentially saw my own forecast and said, there's a really interesting opportunity here in the solar market, the residential solar market, where the whole industry is focused on bringing the capital costs down, bringing down the cost of the modules and the panels and all that sort of stuff. And they're doing a great job. And basically, at a certain very near point, it's going to cross over to where the dominant cost is going to be soft costs, customer acquisition, all of the transaction costs and verifying things and all that. And we were extremely plugged into the industry, and essentially nobody was thinking about that. And I said, okay, cool. This seems like a software problem. I think I can build software that will, create efficiencies and help with customer acquisition. And so let's go after that. And so I kind of quit my job, started pulling that thread. Yeah.
And then name of that company, what was SolarList? How did you get your first customer?
Our first customers, to be honest, we struggled with monetization. We got a couple like proof of concept customers, but the big problem with our whole plan was we executed really well on product. This was kind of like the era of like the lean startup had just been published. Like a lot of the stuff you heard in
just 2012, 2011 timeframe.
Yeah, 2011, 2012, and so it was pretty normal to be going to Techstars, 500 Startups, YC with like a proof of concept and all that sort of stuff. So we built product. We built one of the, now this is pretty common, but we built either the first or one of the first because, I would literally like hired some PhD in Bulgaria to like write the code that translated some of the spatial geometry to Google Maps. But what we ended up building was this thing where you put in your address, pulls it up on Google Maps. You can kind of draw your own roof, and then we do a bunch of things to figure out how many panels could fit, what direction is it facing, what's the solar insulation in that area, and we basically give you an instant quote. Prior to that, it was like people would have to come to your house before you would have any idea what switching to solar would cost. So we built that product. We started taking it around. We got some proof of concept like, oh yeah, we'll pay you, a couple $100 to use this. Or, we did some trial like lead gen based stuff where we would pay, we would run some ads and then they would pay us, $20, $30 a lead kind of thing. And we pretty quickly determined that the right business model was actually closing sales, which was a long sales cycle, which meant we've decided we needed to raise money. And so that kind of set off a experiment in early stage fundraising.
Here we go.
We ended up pitching probably 400 VCs basically in the
400.
end. Yeah. We pitched everybody you can possibly think of.
Wow.
Yeah. Like everybody that was famous in early stage venture, we literally pitched them.
What was the open loop that you used in the email or the intro to get them to say yes? I mean, just getting 400 meetings is impressive.
We had basically, so the meetings is maybe an overstatement. I mean, some of them just said no via email, but the list of people was 400 and all of them were closed in some way or another. Well, I did everything, so we were cold emailing. We had built an impressive product. So I had taught myself to code. I had managed to also get a CTO to work for me for a bit. And so we had built like pretty cool product in a pretty interesting market. And so it wasn't that hard to get at least a bite on the other end of the hook. And then, what we found was two big problems. One was that although clean tech was interesting at the time, it was a particularly very bad time to be raising as a clean tech firm. It was right after like John Doerr at Kleiner had just lost like a humongous amount of money. It was Solyndra had just imploded. Like basically VCs had lost a ton of money in the hard tech stuff that, to be fair, we were transitioning away towards software, but they had just lost so much money that there was a sort of herd mentality that like, yeah, we're not investing in clean tech right now. Mm-hmm. And the other problem was that I didn't know about like how power law worked and how venture really worked. I was just like, I'm trying to build this great business. I'm pretty sure I could build a 50 or $100 million business. There's software here, so let's do a deal, and we weren't really optimizing for like $1 billion outcomes. And at the time I didn't know that was like a kind of a deal breaker for a lot of VCs. So, but yeah, we got a bunch of cool, like I remember one time I was in Italy in New York, the kind of rooftop bar they have there. And I saw Dave McClure, like clearly like on a date or something. And I just like walked over and I was like, hey, this is really shitty of me, I know, but like, I just want to say like, I have this cool company in clean tech. I'd love to pitch you. And, kind of gave him the elevator pitch right there. And he was like, yeah, okay, email me, but yeah,
Did he reply to the email?
Pretty relentless. What's that?
Did he reply to the email?
I think I ended up kind of going back and forth with one of his partners at 500 in New York, and it was sort of standard, like kind of pass email.
Yeah. Okay, so did you end up raising?
We raised like a fairly small, like not really friends and family, but like friends and professional friends round. So we raised I think like 300 or 400K. That we kind of stupidly just put right back into product. We were just sort of optimizing for the idea that we would raise like $1 to $2 million to execute this business plan. We had this, really knew the market. My co-founder also deeply understood the market. We were like, look, it's probably the second longest sales cycle that exists outside of home buying, right? It's a very lengthy transaction. It takes like 3 to 6 months to close. So of course we need capital to build a sales team to be able to, compensate them in the interim. And we just sort of, failed to launch essentially as a business, although we built a bunch of cool product. But
so like, what was the max revenue you did in any given month?
We never did anything material. I think we did like $2 or $3 grand in a month, but it was all like
consulting
one-off projects and stuff. Yeah.
Okay, you what?
We were just never optimizing for that. I didn't know about bootstrapping. I didn't know, we had sort of picked up this playbook that was like lean startup plus what we were reading from, VCs blogs and stuff like that. And we were like, we're optimizing for information and for our deck and for, how we're going to raise. And then we were taking feedback from all the VCs, which I now know, is a terrible thing to do. Don't ever listen to the feedback that VCs give you. It's mostly optimized for you to just leave them alone and refer other people to them. It's not real advice. Like mostly don't take it. But we were like, oh, cool. Like they want to see these metrics and this traction and blah, blah, blah. So we would run all these experiments and stuff like that. And so we were just shooting for that instead of like building a sustainable business, which was in the end a sort of fatal flaw for it.
You shut the business down in 2013 and then start spending the majority of your time on StoreMapper. Were you already working on StoreMapper on the side while you were building SolarList, or no, you started StoreMapper straight after SolarList?
Yeah, it was even before. Yeah, it was on the side. So essentially what happened was, like I said, there was this maybe 18-month period where it was like we had a product, we had our pitch, we had everything, and we were just like, we just need to fund this thing to get it off the ground. And so the binding constraint for the business was like my personal runway. I was living in New York. It's a very expensive place. And I had brought some savings with me and I was doing some side consulting.
Tyler, give us context here. How old were you at this point?
Probably 23.
And what were your all-in living expenses in New York?
Well, I mean, my rent was probably $1,200, $1,500 a month. So, I mean, I was probably burning like $3 grand a month living very, very, leanly. but it's one of those things where often in like a catch-22 where some VCs say they want to meet you out in San Francisco. Okay, do I go spend the money to fly out there and the hotel and the rental car and all that sort of stuff, to take that chance or not? Which I did. I was like burning through frequent flyer miles to like fly my co-founder and I out to Palo Alto to go, and we had like a Y Combinator interview, and then we had other VCs who wanted to meet us. We were staying in this we stayed in this thing called a hacker hostel, which was this like awful hostel in Soma for like $50 a night, just like a just dingy, disgusting place. So yeah, I mean, we were trying to be scrappy, but at the same time, we were just burning through cash, for over 2 years. And so eventually it was like I was basically running on fumes, running on credit cards, that sort of thing. And I had learned enough code to sort of be dangerous. And so I was moonlighting. So I was like working maybe 20 hours a week on Upwork, just finding random gigs as a software developer, even though I would have other people who would build our actual product. So I was doing that to just kind of extend my personal runway, sort of thing. I would work 40 hours on SolarList, 20 hours on that, and that would maybe break even a little bit, but it was still kind of burning cash. And then I was sort of desperately looking for some sort of passive income, so mostly so that I could keep working on SolarList. I was like, just give me something that's going to throw off $2,000 a month so that I can stay in the game. And that kind of prototyping search for something is what led to StoreMapper. It was like I was working with Shopify clients, on an hourly basis. One of them asked me to build a store locator app for them, and I thought, well, okay, this is so common. There must be some plug and play version of this, and there really wasn't. So I kind of experimented with the idea of seeing if I could just productize that versus just kind of doing it as client work. And so I built the first version of StoreMapper on a single flight. And it was.
Are you talking like New York to Boston or New York to San Francisco flight?
San Francisco to Buenos Aires, Argentina.
Okay, there you go.
So it was a longer flight, yeah. But this is a long story. This is actually the flight where I went down there. It was like my first real date with the woman who's now my wife. But anyway,
what's her name?
Anne. Yeah.
So you met her in San Francisco at the hacker hostel, right?
No. We had a bunch of mutual friends actually, and so they had been trying to set us up, and we had met once before. And then she works for the State Department, so she was going down to Argentina for a couple of weeks. And she was like, "Hey, you should come, ha ha ha." And I was totally mobile, and was still trying to do fundraising, still trying to do everything, but it could all be done from a laptop. I had a pile of freaking flyer miles, so I said, "Fine, I'll go there. It'll be cheap. We'll go hang out. Sounds good." So I had this time box period of time where I say, "Okay, I don't have a lot of time, but I think this is a good business idea. I'm going to try to build the leanest, most revenue-focused version of this that I possibly can." Built the just most terrible, like barely does what it says on the tin kind of version of it, and immediately sent it out to everyone I'd ever worked with in the e-commerce world. Said, "Hey, here's this product. You drop it in, you drop a little snippet in, it makes a store locator. You send me a spreadsheet, I upload it for you, that sort of thing. It costs $5 a month. Here's where you pay." And lo and behold, we had like 5 people sign up for it in a week. And so I thought, okay, this is something here, and started kind of pulling that thread. From there. Yeah. And then so somewhere along the way, I actually built it up to where it was doing about $1,000 a month in revenue. But it still wasn't enough to sort of keep things going with SolarList. And so I eventually just had to wrap it up. I was like $60,000 in credit card debt, basically essentially broke, couldn't afford to live in New York anymore. And I just told my investors and my co-founder, I said, "Hey, look, I can't do this anymore. We're going to have to wrap this up," and left New York and reduced my cost of living, focused on StoreMapper, which was working, as well as the freelance work I was doing as well still.
most investors, when they invest, they're really betting on you as a person. And they, people, especially early stage, pivot all the time. There's tons of stories of founders that start off on one thing, they pivot to another, and they keep the same cap table to keep the investors on board. It sounds like you had a clean cut. You actually shut the business down, and your cap table then for StoreMapper was clean. You owned 100% of it. Is that accurate?
Yeah, for sure. Yeah.
Any pushback there from folks going, hey, we believe in you. Why are you not giving us anything in this new thing? You're just going to shut this down?
No. My investors, they were very clean tech focused. They were professional investors for the most part. And they totally understood like, hey, we're shutting down this business. And yeah, nobody really wanted to even mention like, hey, give us a taste of this little side project. Because to be clear, it was not at all clear it was even a viable, business, anything more than a little, hobby widget thing, essentially. It was only a little bit later that I kind of discovered that, there was enough meat on the bone there for it to be a real business. So no, it was totally clean. I owned it.
So San Francisco to Buenos Aires, you're going down there because Anne, your wife today, was with the State Department. You build StoreMapper on the plane. You get pricing up $5 a month. You sign some people up. On a keynote you gave on stage, I believe it was 2 or 3 years ago, you said you hit about $200 in MRR pretty quickly, early 2013. And by the end of 2013, you had passed about $2K a month in MRR. That then went on in late 2014 to $7,000 a month in MRR, and in mid 2016 to $18,000 in monthly recurring revenue, 1,500 customers, and a ridiculously high conversion from free to paid of north of 50%, with also very low churn, less than 1%. Explain to me how you went from 2K per month, right, a couple months after your plane flight where you built it, to 3 years later, 18,000 in MRR.
Well, in part, it was just the full-time focus, right? So this is, we can foreshadow a little bit and come to it, but one of the things that we really try to focus on with Earnest is the value of being able to switch from the nights and weekends to, hey, I'm giving my full energy, the majority of my productive working hours towards this versus the leftover, remainder, when you're half exhausted and you've already worked, 10 hours that day. And so that was a big change, right? So when it went from 0 to 2K, that was almost entirely when I was still working, at least to some extent, on SolarList. So it was like I would literally say I have less than 10 hours per week to work on this. And so, support tickets would just sit there. And I was just like, I can't do this. I have to work on some product. So like, I'm just not going to answer these for maybe 10 days. And then I'll send a really, really apologetic note saying, hey, I'm so sorry. Like, it's fixed now, here you go. And so that was a big switch, was that, okay, once I gave it my full-time energy, within 6 months, it was a full-time salary for me. So that was kind of my goal. It's like, okay, if this makes sort of in the $70,000, $80,000 a year kind of range, I know this is something that I can somewhat indefinitely, right, for the foreseeable future, this can support me. And so that was the goal. And we got there in I got there in 6 months, essentially, with just full-time energy of actually improving the product, actually thinking about marketing, no real secret sauce there. And then from there, a lot of the things that I did are some of the things that I look for now. So, really relentlessly focusing on really, really high conversions in the funnel. So I think, a lot of the metrics that we see are often from kind of venture funded startups, just because that's where like all the media ecosystem is. I mean, obviously you know this, and you're maybe not so much part of that, but so much of it is focused there. And so people say, oh yeah, I've got a great conversion rate of like 6%. To me, that's like a horrifically leaky bucket, right? You're a bootstrapper. You don't have the time and energy to bring in thousands and thousands of customers. You want 10 customers. You want 10 free trials. You want 7 customers coming out the other side, and you want to keep them forever. And so that was kind of my focus all along, was being very, very efficient with capturing and converting customers versus kind of top of the funnel growth. So
I want to talk about that 50% conversion rate here in a second, but I do also want to pull something out that I think you're not giving yourself credit for, maybe because you were in the moment, but I think it is such, like, I look for patterns when I talk to founders. And one of, in my opinion, the most effective ways, if you want to live that American dream that you've defined, or you at least said, hey, this is where it's trending, that believe in building, owning, and selling a software company, a genius way today to start that is to do exactly what you did, which is you don't have an idea, but you want to have a software company. Teach yourself some code, go on Upwork and Fiverr, pick up side jobs in a hot space. You chose Shopify, obviously smart choice there, but you can go find patterns like that today. Do custom code and listen to what these businesses that are contracting for you are asking for. Build a little high utility tool for them, and they become your embedded customers to start with. That pattern is, in my opinion, a great blueprint for anyone that wants to get into software.
I totally agree. I think it's highly repeatable. I agree with like each element of that is something that is kind of worth breaking down, right? It is about, so we were pretty early on Shopify. I was in the App Store, when we launched Store Locator app, it was the first one, in there. So we just got 100% of the sort of traffic from that, and we were able to sort of pick.
You were the first store, like the map, not the first Shopify app ever.
No. But I mean, pretty early on,
2013, 2014. Yeah.
Yeah, they probably only launched the App Store in like 2012. I'm not totally sure about that, but I mean, it was sparse. And nowadays when you go and you type anything in, you get 72 results. Yep. Just being early onto a growing platform is definitely a viable strategy. And then I think just being able to deeply understand a customer base, even through that period. I was still in that period, let's say, from 2K to 7K to something like that, I was still freelancing. So I was still working probably 20 to 40 hours a week as a Shopify focused Rails developer. So I was really, getting constant feedback from client base and being able to bounce ideas off of them. It let me be able to pull more value into the product, right? So it started off as like hey, this is a check the box. We know we need this, so let's just check the box. But then, that feedback loop of talking to the customers and then thinking about product led us to, for example, a conclusion where, hey, actually, the analytics here are really valuable, right? Like when somebody is saying, where can I buy your product near me in Portland, Oregon, and you're getting 7,000 searches like that a month, and the answer is nowhere. That's actually really actionable information. Like you should probably find distribution in Portland, Oregon, and that should be surfaced and something that a marketing person can use in concert with other tools to look for opportunities, and alerts should be notifying you that, hey, for some reason you're blowing up in Switzerland, and you really should find a way to actively market there. And so we found those bits of value and pulled those into the product, and then was able to really hugely increase the average revenue per customer by adding more and more value there. But it was mostly a feedback loop of talking to the customer base essentially.
And so help me understand how you thought about onboarding, because again, you shared in this talk you gave on stage, 50% conversion rate from free trial to paid. So 2 questions there. What was the free trial, and how did you decide where to put the paywall for people to sign up where you knew 50% would convert?
Yeah, I mean, well, so it was I think it was a 14-day free trial with a credit card up front. So those are obviously for calibrating your metrics, some of those things matter quite a bit. So obviously putting the credit card up front,
huge.
Yeah, and it may or may not be the right decision, right? But it certainly is going to make your free trial to paid conversion a higher number, right? Whether or not it, on net is beneficial is something to be tested, but that's definitely part of it, right? I don't know that we would have anywhere near that if we had an open free trial or we had a freemium plan or something like that. But I think. I do think there's a huge amount of low-hanging fruit in the onboarding process for most products. I think that a lot of times founders just kind of fail to just take a moment and empathize with your customer and think about, okay, what is the actual job to be done here at each of those stages of the process? Not like what do you want them to do, not what is your sort of product set up in such a way, but how do you really remove friction from every phase of that process? And so I was just relentless about automation and clarity at each phase of the onboarding process. So an example that I see all the time is like, you have an empty state for a part of your app, right? Where it's eventually going to be filled up with records, and somebody comes on it during onboarding and it's just this empty list of rows. It's like, no, if it's empty, it's useless. So you should replace the empty list of rows with a video on how to fill this thing up, right? Like, right now we obviously know that you have not successfully done the thing that puts data in here. So we should optimize for teaching you how to do that at this point in the process. I think I have a big post somewhere of like all these little nitpicks, but people use bad error messages, right? It'll just be like you upload a CSV and it's just like CSV invalid. Like, come on, no. You need to write like a ton of logic in there to be like, look, it's obviously a .xls file. Like, don't upload those. Upload these. Like, okay, this, you didn't put the name column. Like, make it so that people actually can
and some copy, right? Nice try, Batman. Let's try this again. Your XLS file needs to be CSV, or
Exactly. Yeah. And just generally, like, one of the things was integrating your help docs, your we use Intercom, but any kind of in-app chat with actual milestones, right? So I would set up automation where it was like, okay, one of the key things would be you need to like upload a list of your stores. It doesn't do anything unless you put the data in here. And so if 5 days go by and you haven't done that, we would just automatically send an in-app message and an email saying, hey, seems like you haven't done this yet. Here's various options. Here's how to do it. Here's how to book a time with me so I can tell you how to do it, and here is how you can forward this to your developer, your marketing person, so they can do it, right? And it's just usually a lot of low-hanging fruit and onboarding.
Tyler, how did you? Was it an automatic conversion on the 14 days to the paid trial since you already had the credit card?
Yeah, I think so. Yeah.
What did you do? Because I think a lot of founders fall into this case. It is a scary moment when you do an analysis on your paid user base and you look at the activation metrics. So in your case, it was, have they uploaded the CSV file yet? Mm-hmm. If you looked at all of your paid users, your 1,500 you had, and you saw that 300 of them have been paying for like 4 months, but have not uploaded the CSV, and founders go into this flight or fight mode. They go, oh my gosh, I don't want to email them because then they might get scared and cancel. But like, they're not getting any value. It's like a small credit card charge they don't know about right now. What do? Do you re-engage, or do you just let it go and hope it fixes?
I don't know, but I think that is I think that's a question of like treating a symptom, not an underlying cause, sort of thing. My product never had that situation, in part because it was so proactive at reaching out to you if you didn't hit the right milestones, that it didn't allow you to just forget about it, right? It was just still from the get-go, like what I think that is a symptom of is bad onboarding, right? Because it means that somehow people failed to hit relative milestones and you didn't reach out to them in some sort of way. So I think I don't really have a suggestion for what to do in that moment. I think the ethical thing to do is to, email those customers, try to get them either, to actually use the product or go ahead and cancel for them. But I think it's something you can avoid upfront by actually having, good automated onboarding.
Yep, a great email to send to that cohort. If any of you guys are going, oh my gosh, I understand Tyler and Nathan are talking about right now, I have that cohort, is to send an email with the subject line, we're kicking you off our platform. It will have a massively high open rate. They will all re-engage, and they will probably even laugh like Tyler just did, which is like, it builds humor into your product. But you should,
I like that.
Totally agree with you, Tyler. So you did this so well. You had less than 1% monthly churn. What was like the activity that you measured on your paid cohorts week after week, month after month, where you knew if they did that one thing, they were very likely to keep paying?
Well, so part of that is a fundamental nature of this product, and it's something that I often tell founders to contemplate if they're sort of at the idea stage, and something we look for, at the sort of investment process is these kinds of set it and forget it, value creating products. I just think they inherently have much lower churn if it's a product that it's a, project management tool that everyone on the team has to use daily and weekly and monthly. Just so many more touch points for people to decide, okay, we use this all the time. So, there's a lot of value in getting it something that's 10% better, right?
Mm-hmm.
Because we use this so much. So if something has an extra feature, it's worth it to switch, or, it's worth it to cancel if it's not working like totally perfectly. There's definitely a category of products that once you set them up, they pretty much do their job without you having to interact with them a whole bunch. And this was one of those, right? So it was like, okay, once you install it, once you have done the complicated sync to your, your backend system that that updates every time you have a new location, it's installed on your website, your customers just use it. It can just sit there and take 100,000 search queries a month, and you don't have to touch anything.
Yep.
So that was a big part of it. It's just actually the product design was designed around something that's likely to produce low churn. Yeah. And I think, once you get there, that's why the relentless focus on sort of onboarding is so important with these kinds of products, is that like once you get someone there, you're good. The lifetime value, just because of the absurdly low churn, is just astronomical, because it's just customers stick around forever. But yeah.
So you build this to call it 18 grand a month, or about a 220-ish K ARR run rate type of company. You then ultimately sell to SureSwift in 2017, which you should think about like micro private equity if you haven't heard of those guys before and you're listening. But this idea of selling was clearly bubbling in your brain much earlier than that, because I think it was 2013, you posted in the New York City Ruby meetup group a blog post that said, "Unsexy, profitable SaaS business for sale or partner." What was the thinking behind that post?
This was when I was still running SolarList. And so I was sort of thinking it was still kind of hit or miss. This is one of the problems of being in the middle of a sort of venture fundraising process, is it's very binary. It's like you're not really making steady progress. You stay in the game, and then you get there, or you just never get there. And so I was in that that phase of uncertainty where I said, okay, this is a thing. I think it may have had like 1,500 a month in MRR. Like, this is a thing someone would buy, and I would put 25 grand in my pocket if somebody was willing to just like write the check and take this over. So I put that post in the New York Ruby meetup as like a random thing. I don't know, maybe these people will buy it from me. Got a huge amount of interest, and probably had like 60 something people email me off of that, because meetup, it was to a meetup group, but it's actually public and indexed by Google, so it's also searchable. So I had random people who weren't a part of that group find it and email me. I guess I ran a process in the sense that I took some calls and mostly found that it was not worth my time to sell. A lot of kind of vulture folks at that stage, they were like, yeah, I'll give you 10 grand for it or something. It's like,
it's not worth your time. Yeah.
I'll just keep it.
It's a very effective strategy though. Like, this is also, in my opinion, a big difference between VC-backed companies and bootstrapped companies. When you are mentored by a board and VC and you talk about the exit conversation, it's always, you're never for sale. You want to be bought. You want it to be a strategic buyer so you can get a ridiculous valuation. But for a bootstrap founder doing anywhere between 10 and 100 grand a month in revenue, if you actually already have a blog where you blog about revenue growth or tweet about it, if you just say, and especially if it's a good headline, like unsexy, profitable SaaS business for sale, you can actually get a lot of bids coming in. They will all be super low, but if you're good at generating a bidding war, you can get the LOIs, we'll talk about that in a second, up to a point where it's actually a very valuable offer for you to exit. So you did this in 2016. You went to MicroConf, which is put on by the Tiny Seed crew, and you met some folks. Walk us through MicroConf and then up to the acquisition in 2017.
Yeah. So, to your point, is exactly correct in the sense that through a combination of, like that meetup post, and then along the way, I was sort of inspired by a lot of the founders who were kind of doing radical transparency, like Joel at Buffer and Josh at Barometrics, and some of the other folks who were publishing their revenue numbers and a lot of detail about building their business. In part, I think for me, I always have this really strong aversion to writing about how to make money on the internet, because it's so easy for it to like leak into kind of scammy stuff, that I was like, look, if I publish the numbers, they will give me exactly as much credibility as I deserve, right? Like, take this with the grain of salt that it's like, I've not built nothing, right? I have built a decent sized business, but I also haven't built a $20 million a year business. So that's the appropriate context for this conversation. And then I would write about what was working, what wasn't working, strategies, that sort of stuff. And I felt like that went really well. But as a result, people would know. I say, oh, hey, looks like now you're a 32K MRR business, like, blah, blah, blah. And so there was just a constant stream of soft bids, inquiries, that sort of stuff, a handful every month of folks saying, yeah, if you ever want to sell, like, talk to me. And so I kept the list. I basically would just say no, like I'm not interested right now, but I would kind of note it down. And then I went to MicroConf and I met Kevin from SureSwift, and he sort of said, so basically they have a business that is exactly this. They buy mature profitable software businesses, and then they just own and operate them. So the founder is kind of hands off. And that was something I was kind of thinking about. I've been running it for about 5 years, and it was paying me like a really nice salary, but I wasn't super
What was the salary it
about
was paying you?
I mean, I was probably making about $250 a year after the team, right? And this was for something that was properly like 4-hour work week to some extent for me. I mean, the last year that I owned the business, I took a year off basically with my then girlfriend, and we traveled. We hiked Kilimanjaro. So I took like 12 days offline. I was like, all right, team, like I'll see you later. And we were basically just like going all over the world. I was still definitely working, like so we hiked Kilimanjaro, we went on safari, and then I spent like 3 weeks in Cape Town, actually working and doing stuff. But I mean, I was really down to averaging probably 10 hours a week sort of thing.
So your max expense that last week up to the sale, then, like your average monthly expenses to run the company besides your salary, I mean, they had to be less than 3-4K a month.
No, we had like 4 folks who were more or less full-time. So,
okay.
Yeah, no, I don't remember what the exact run rate was, but
well, I guess what I'm asking is, when you just said you did 250 sort of after everything else that last year, is that $250,000 in salary that year?
Yeah.
Okay, wait. So you must have grown much bigger than, or a little bit bigger than 18K in MRR then.
Oh yeah. I don't think I can say anything about what the final number was. I think I released it in a series of blog posts, but but at the time we sold it, it was a lot higher than that. Yeah,
I was about to say, I'm going, wait, hold on, 18 grand in MRR is 220 grand in ARR, and he's saying he'd take 250 out of that. Math doesn't work. Okay, got it.
No, it was a lot. It was definitely a lot more than 18. Yeah,
got it.
I had a small team. I had basically 4 folks who were full-time, fully distributed, totally remote group. But yeah, so it was something that I was in this kind of classic position of, okay, do I try to really keep investing to grow this? Do I just let this kind of hang out and pay me a salary while I do other stuff? Or do I sell it? And so that was on my mind quite a bit when I met Kevin. We had a beer and he was saying, look, this is what I do. I buy these kinds of businesses. I would love to talk. And so kind of had the conversation with Kevin, felt like it was getting real. And to your point about a bidding war, I don't think I necessarily wanted to create a bidding war per se, but I do often tell folks in any kind of like high stakes negotiation like that, and this is not something I invented, like the next best alternative or whatever,
BATNA.
Yeah, like it's all basically investing as heavily as you can into your plan B is the best way to get the absolute best outcome out of your plan A. And so I was like, okay, well, if I'm going to do this, I'm going to do this. So I basically blasted the whole crew, all 70 or so people who'd made any kind of vaguely serious offer and said, hey, I'm vaguely serious about doing this. So, if you want to chat, let's chat. And basically had a proper like funnel trying to get as many people as possible to the same stage at the same time, right? Because you don't really get any value if someone is really interested, but they're still at the diligence, learning about it stage, and someone else has already made you a firm offer. So you have to stall them for 3 months while this other person gets there. So you wanted to I took a process and basically
tighten that for me. So 70 emails sent, how many replies?
Oh man, I have no idea.
I guess.
Ultimately, I got probably a dozen serious conversations that I felt like, one of the good things was because I've been so transparent throughout the whole process, the diligence process was actually quite easy. It was just like, hey, look, you
go read the blog post.
Metrics. Read the blog post. Go look at bare metrics to see my live MRR, churn, ARPU, all that sort of stuff, and tell me what else you need to know. So it wasn't super challenging in terms of deciding, who to sort of engage in diligence with.
How many LOIs from the 12 series conversations?
I had 5 people make a pretty serious, like what I felt like was a serious bid, and 3 LOIs and offered, and then ultimately we went with SureSwift.
Yep. Okay. Before we jump into Earnest, wrapping this up, there's other people that probably have their own version of a StoreMapper right now, and they're wondering, well, like, what value do you get on this sort of thing? You can't share the actual sale price, but let's step away from your company for a second and just talk in general. Companies selling this size, right? So call it between, I'm going to make this up, between 200 grand in ARR and $1 million in ARR that are sort of bootstrapped like this, generally sell for a multiple where on profit, where you can also add back the owner's salary. Once you do that, so you said you were making, call it 250 after everybody else, so add that back to profits. What sort of multiple should people be looking for on those earnings after their salaries are added back?
Yeah, I hesitate to say because I feel like you would know this better than me. I mean, you have a better data set than I do. What do you think?
I don't, it all, for me, it's, this is more art than science. So that's why I always ask the science question to see if there is a scientific result. I mean, you chose not to use a broker, right? I mean, FE International will say, we charge 15%, we'll run a process for you, and 15% is expensive, but you should pay us 15% because we're gonna get you a 15% higher price. That's the justification. Whether it's real or not, who the heck knows? You didn't use a broker though, so you must have felt like you got a good multiple.
Yeah, I kind of ran my process, and then one of the things I did very late in the stage of things, because you can run the process pretty far before you're actually signing any kind of legal documents that are binding in any sort of way. So I basically had LOIs, and then I went to brokers and basically just said, hey, like, can you beat it? Like, does it make sense for me to engage you in a way that's going to be on net, better for me? And they were like, no, you should take one of those. I don't know. I mean, my sense is, I think if you ask a bunch of people, they would say a number that's in the range of 5 times that is market. When a bunch of deals were being done publicly, I feel like that number is going up and up over time. So I don't know where it sits right now because I'm super focused on like the early stage. I'm not really like doing deals or hanging out with folks to do it, but I think it's going quite a bit up from there. Yep. But I don't really have my finger on the pulse right now.
So let's now fast forward. You sell that company, you travel the world for a bit, then you start putting pen to paper in August of 2018 about this idea of, you want to help more quote unquote StoreMapper personas and less quote unquote solar list kind of use cases, right? So you came up with the idea of Earnest. You raised, I think you said at the top of the show, 3.1 million for your first fund. Was that most your capital, or how many LPs did you raise from?
No, it was a bunch of LPs. I mean, some of it was my capital for sure, but I think we had about 40 total LPs. Yep. So, it was almost all just entrepreneurs. So we didn't have anything really approximating institutional investors in there, with the exception of, they've been public about this. So SureSwift also invested in our fund. So it was a good transaction, obviously, by my company, and then they turned around and invested in our next thing. But other than that, in terms of an entity, everything else was individuals. So it was, a normal kind of amount of outside capital, basically.
Yeah. Yep. And walk us through the term sheet. So if someone's thinking today, okay, I'm learning about Tyler. I like this guy. I like his story. I want to go apply and try and get capital from him. What do the deals look like, and who's the right kind of entrepreneur?
Yeah. Well, so I'll take a little bit of a step back. So I had sold the company. I was kind of thinking about, all along the way from blogging and things like that, I'd met a bunch of folks who were, at various parts of that journey. A lot of them very aspirational, some of them early stage, a lot of the folks later stage sharing, their kind of wisdom with me, and really noticed that, these businesses, once they get to a certain point, you really can properly bootstrap them, right? You get to maybe 10, 15, 25, it depends on your cost of living and all that sort of stuff. But somewhere in there, it becomes a business that you can keep, growing through free cash flow. But there is still this classic early part of the process where 50, 100, 150, 200 grand will really, really get you over the hump, especially if you don't, have a spouse who can cover your costs while you're kind of building, or you don't happen to inherit a bunch of money or something like that. This can be a material obstacle to starting a business. And so, but once you get to the other side, you have these businesses that actually, it's not just micro PE. Like everybody everywhere is thinking about, wow, these are great businesses. I would love to buy them. I would love to build one. I would love to own one. I would love to invest in one. But you got to get over that hump to this sort of sustainably profitable, maybe not even profitable, just kind of, growable through free cash flow kind of phase. And so that was the thing that I was thinking about. How can we fund that? And, sort of immediately ran into two principal problems. The first one is the actual kind of typical quiver of investing products for early stage startups just weren't aligned with, let's say, someone who comes to me and says, hey, I want to build the next Basecamp, or I want to build the next WildBit or something like that. I want to build a profitable, sustainable business. If I write you, a check on a convertible note that is premised on the idea that at some point you're going to raise a Series A and a Series B and all that sort of stuff, and you don't do any of that stuff, but you build a really successful, profitable business, I don't really have a way to get my money back. So that was problem number one, was how do we design something that aligns us with these kinds of outcomes?
Why is that though, Tyler? I mean, that is the reason that the traditional convertible notes have an interest rate. It's to disincentivize the entrepreneur from just letting that thing accumulate interest at 8% and to actually go out and do a priced round.
Right, exactly. So, it's just about alignment, right? I mean, you're right in that there is a way for me to get my money back. It's by basically forcing an entrepreneur to do something they don't want to do, right? If they never intend to raise an additional round of financing, most of the early stage instruments, convertible notes and safes, really are orientated around the idea that you will raise another round. And if you don't raise another round, they either do stuff that's, not great, like accumulate interest indefinitely, which can actually, depending on how they're structured, like a convertible note with an 8% interest rate, if you invested that in Basecamp, maybe it might work out great for you because it's been 18 years of compounding interest and you actually own 70% of the company if they ever sell it.
Wait, why is that, Tyler? You would pay, if you were Basecamp and you took a convertible note early, you're living off great cash flow, you'd pay off the note and stop paying the interest.
That is fair. Yes, you could do that. Yeah. So basically, it's not mutually beneficial, right? I mean, the word I often use is alignment, right? Mm-hmm. So it's either a situation that's bad for the founder, or it's a situation that's bad for me, right? Like if they pay it off, well, I only got 8% interest on this actually fairly risky venture, right? And otherwise they end up, in some middle ground where it's just accumulating interest rapidly, and they don't have $200,000 to pay off the note. So it's getting to be more and more and more of their company. And so they're forced to take a price round, right? It's just none of those are aligned to where the outcome is, we're high-fiving with the founder, right? And so that was the principal problem, is like, how do we make it to where what you want to do and your version of success is also our version of success? Does that make sense?
It does. So let's say the type of founder applying to you wants to build a great cash flow profitable $5 million ARR business. That would be a great win for them. Small team, they travel the world, do whatever. They would want to pay you back that initial capital so that they are not continuing to pay essentially a form of interest rate, or you define it a different way. It's essentially a founder salary, and then anything above the founder salary that they pay out as a dividend to you. But it goes on indefinitely unless they prepay, correct?
In the structure that we use?
In Earnest's structure, yeah.
I don't think so.
Okay.
So let me just describe what it is, and then we'll recalibrate. So we designed the shared earnings agreement, and the way that it works is you can think of it essentially as like a baseline, one of these convertible instruments, right? So in the sense that we invest an amount of money up front, you can convert a percentage. You can say, okay, we just to give numbers, that's $100K, and that means 10%. And that's where you start.
So there's a cap then on the instrument.
Right, exactly. Yeah. There's a basic simple formula that says, okay, this converts at this amount.
Yep.
And we call it, valuation cap and stuff like that. Yeah. And
so just to make that real, you'd say, hey, here's $100,000 and it's at a valuation cap of $5 million, which is equivalent to, that's how you calculate what the equity is if it does convert.
Right, exactly. So that's a baseline, and that is the percentage of the company that we get if you sell the company or if you raise another round. You go on, you say, hey, actually, we're going to raise $2 million and we're going to take a big swing at this. Okay, Earnest's ownership is going to convert into that percentage.
Yep.
There's a separate piece which is called shared earnings, which says, hey, if you get to a point where you are very profitable, right? So you are, and we define this with this term called founder earnings, which is there's this classic problem where the company is profitable and then the founders basically decide how much they want to chop it up into a really nice salary for themselves versus dividends that they then share with their investors. We say, look, we don't want to get into a debate about what's salary and what's dividends, because usually how that plays out is you have a board level discussion about what is a fair salary, and it's all just kind of silly. We just say lump it together. If it's above a certain threshold, then we are entitled to a piece of it. Whether you're paying that, whether your accountant tells you it should be a $700,000 a year salary or $100,000 a year salary and $600K in dividends, you choose. but we do the same math, and we are entitled to a piece of that. As that piece comes back to us, there's a pretty simple formula that buys down our original percentage, right? So if we started at 10, as you're making those shared earnings payments, that percentage number is going down. It doesn't go to 0 because then we're kind of like debt. Like, we can eventually get totally bought out. And if we backed you with, 100K and you turn out to be the next GitHub, we're going to be kind of sad that we didn't get like a really solid return.
But that's not your model though, right? Isn't that this is where I have so many questions about this. Your model is not to back the next GitHub. Your model is to give the founder optionality.
Yes, it's true. Yeah, absolutely. But so optionality goes both ways is essentially the way it works, right? So if we are giving a ton of optionality to the founders to figure out a way to say, hey, if you want to invest or you want to sell this much of your company, but we're actually going to give you a mechanism to repurchase a significant portion of that, then we also don't want to get like fully repurchased so that if the company turns out to be a wild success, and GitHub is an exaggeration, right? It could even be a company that's worth 100 million.
Let's say Nathan Barry with ConvertKit went through and was an early Earnest company. He is a candidate that would have paid this down to 0 because it has built a great lifestyle business that's highly profitable.
Right.
What you're saying is you can buy it down a lot, but not all the way. We want a little bit of the pie. What's the floor? 1%, 0.5%, 5%?
It's usually reducible by 2/3. So if we had written a check that entitled us to say 9% of ConvertKit, Nathan absolutely would have, paid us down to about 3%, and we would be very happy to still have that 3% because they've been doing so well. That's a great example of exactly what we're shooting for there.
Yeah. So this is where I get stuck. So I always try and role play, like put my head in where your head was and where my head was at our first companies when we were bootstrapping, right? If I take Earnest money early on, and let's say it's 100K on a $1 million cap, so 10% of the company, and you and I agree that Nathan, the average salary in Austin, Texas for a founder is 50K. So that's my thing in the contract, 50K. And anything above that, we split, right? Accordingly, weighted. If the company ends up doing better than I anticipated and is just printing money, I'm going to want to pay you off. I'm going to want to pay down that 2/3%. And then I want that other 3% equity. We're going to want to pay it all off. However, you managing returns for the 40 LPs you mentioned do not want that payoff to happen in that case because you want as much equity as possible. And specifically, you've protected yourself with a specific term you publish called this prepayment term, which says from the site, the company may not prepay any of the amounts it's obligated to pay to the investor due under this agreement without the prior written consent of you, the investor. Why would you let a company that's taking off buy down your equities? But you would never let that happen in the takeoff case.
We probably wouldn't. So to parse that term a bit, so there is this balance. We are taking a risk alongside the founder that, there's a version of this that works out suboptimally for us, right? We do back a ConvertKit or we back a GitHub, and initially we have, 10% and we get paid, 2x our money back, and that buys us down, by 2/3. And that's a really bad trade for us, right? Because we would much rather have kept it up here, right? and had the whole 10% of this, massive company. We take that risk essentially. So the founders are allowed to make that payment. They're not allowed to prepay in the sense of just dumping money at us. So what they can't do is just say, here's a check, 300 grand, boom, like we bought you down, right? And again, the reason for that is, let's say they negotiate an acquisition, right? And they know they're about to get acquired for a huge sum of money. Absolutely, they're going to go like, write me the biggest check they possibly can and buy me down as much as possible. What they can do, and what we cannot prevent, is per the formula, if the business is profitable, right? If the founder earnings are generated and they are in the books, they are absolutely entitled to pay us the full amount. We get a percentage of that, and we can't prevent them from paying us that, right? Even if we don't want them to. And that's just the agreement. It's like, look, if you build a profitable business, you are entitled to, make those payments back to us, which will reduce our interest and may or may not be like a bad trade for us in the long term.
I misunderstood that. So if there are profits on the books that are coming in each month, you as the fund cannot prevent them from paying you back the. Oh, okay. I misunderstood that. Got it.
Yeah.
So this clause you put in your contract is specifically to avoid the scenario where they have an acquisition offer. They want to like juice their return, which by the way, any rational person will want to do unless they just really like you and your best friends, right? And they want to give you an extra 7%. This term is to prevent that from happening.
Yes. And so this is the effect of, one of the things we did from the get-go. October of 2018, I published a draft term sheet of this, put it on Hacker News, put it everywhere, left the comments open in the Google Docs, and just got like a flood of people red teaming this thing like crazy. What about this? What about that? What about that? Yeah. And one of the things they sort of rightfully pointed out was like, hey, not only the scenario you just described, but if you had an acquisition offer lined up, you'd go get a loan, right? You'd go to a loan shark to get the money to pay me back as fast as possible. So you basically say, look, you're entitled to pay us what the contract stipulates, but you cannot just shovel money at us unless we have, a mutually agreeable sort of situation. And look, I mean, there's still ways we could get gamed there, right? There are
everyone they move all their contracts from MRR to ARR. They pull the cash forward, and then they put it stick it out. Interesting. So let me just, I guess, the most telling, I think, point in terms of how you're thinking about your facility is how you answer this next question, which is your fund returns, which ultimately the way that you build this vision is to be able to raise more money to support more entrepreneurs. So you have to get a good return on this first fund, a good story there, right? Do you think most of your returns will come from sort of cash flow payouts over a longer period of time, or from these companies being bought 2 and 3 years in? So it's exit events.
Yeah, I would say that if we're talking about, so one of the things is, what lens are you using in terms of, because sometimes when people evaluate funds, they often use a blend of both like cash on cash, right? So how many literal dollars are coming, and then there's the actual like IRR, right? The ROI, the percentage number, and the timing of the cash flows matters a ton there. So what I will say is, if you're talking about DPI, you're talking about actual cash dollars coming back to us. I think the majority of those cash dollars come from exit events. Or at exit event, either the company sells, right? Or we at some point decide that we need to sell our interests, right? Because we've backed the next space camp. They're 16 years in. They have no intention of creating liquidity, but we need to get liquidity for our shareholders. There are people who will buy that interest from us, right? So combining those two together as quote unquote exit events, the majority of the dollars have to come from that, and they don't have to. I predict they will, and the main reason is the asymmetry, which is you can, when you build a very profitable SaaS business, you start to get monthly, inquiries for people who want to offer you a life-changing amount of money. And so to pay us a substantial amount of shared earnings, the kind of profit share piece, you have to build a very profitable company, and you have to consistently decline those, for quarter after quarter, maybe for year after year, until you hit the max cap, because we do have a cap on the lifetime amount of shared earnings you can pay us.
What's the cap typically?
It varies, but you could say it's like 3 to 4x our money. And then if you pay that back, you never pay us another bit of profit share ever. And so, but you basically have to decline to sell, right, for that large period of time. And any time that you say, okay, no, actually, I'm going to sell, right? There's that asymmetry. And then additionally, you have the other asymmetry, which is that you can build a very sellable business without generating substantial profits. You can be reinvesting into growth, and so there's just so many scenarios in which liquidity for us, in terms of cash coming back to us, comes in the form of some kind of exit, and then far fewer if you just like game out the probabilities of substantial amounts of money coming by a profit share. So the way I think about it, so then go back to the other question, which is think about cash on cash returns, you think about IRR. Our idea here is to be indifferent between shared earnings and exits, because it is not guaranteed, but the idea is probably the profit share piece comes earlier, right? And then the exit probably comes much later. Maybe you start getting profit shares in year 2, 3, 4, that sort of thing, depending on how they run their business. And maybe the exits come in year 5, 7, 10, right? And so if this works exactly according to plan, which, who knows, but the way we sort of try to structure the fund is that we don't really care if the founder is slamming on the gas, reinvesting every dollar and trying to build enterprise value that they eventually, turns into liquidity for us, or if they are, taking their foot off the gas and just deciding, hey, I put a ton of, sweat equity into building this company. I want to pay myself a really, really nice salary for a couple of years here, and they're taking profits and we're sharing in those. Mm-hmm. Ideally, we should be indifferent between those two on an IRR basis, right? Because, like fewer dollars but faster can be the same from an ROI perspective as more dollars, much later. Sorry if I'm dumbing it down, but I'm just trying to make sure
it's not. But the IRR game is a game that that is how every major traditional VC plays the game. And you strike me as a guy that is not trying to play that game. But the way
I don't know if I agree with that. The IRR game is.
The IRR game, every VC upsells, like the model is get your best friend of the bigger VC firm with a bigger mother fund to mark up your thing and pitch a massive IRR return so you can go raise the next fund.
So this is getting into the weeds a tiny bit, but I guess we can get into weeds. The IRR game, I think, is mostly a game, and Chamath Palihapitiya has like an awesome, I think, his tweet storm blog post, his investor letter is great on this. So that's IRR from the perspective of markups, right? That's saying I put 100 grand into this company. That 100 grand is now worth 500 grand because some other VC has come in and invested at a higher valuation. So you're taking a paper markup. What I'm talking about is cash IRR. I'm talking about an IRR of literal dollars coming out.
That's DPI. That would be DPI then. Dollars paid out. I mean, that is why those two terms exist. Is one, in my opinion, when all the VC, like I'm an LP in a bunch of VC funds, and I get two reports. One is the DPI, and one is like the on paper IRR.
Yeah, that's a fair point, but IRR is a very, there's a formula in Excel called equals IRR, right? So there's IRR in the context of how VCs want to portray IRR, and then there's just like, okay, like it's an internal rate of return. What it means is basically, it's the ROI, assuming I can infinitely reinvest those cash flows into equally profitable ventures, right? It's also like a basic finance term. And so that's what I mean. I don't mean IRR, I guess, in the sense of paper markups versus cash markups. I mean, like, if you assume that we have a ton more companies, we can continuously reinvest, then over time, and if our IRR is 20% and we're doing a good job of reinvesting the money that comes back, we should show a 20%, over time ROI. And so that's how I think about it. It's basically just a way to do time value of money, right? Because 3x cash on cash, if it comes in 2 years versus 10, is not the same.
That's correct. Yeah. So when you're about to fully deploy Fund 1, you'll go out to your current 40 LPs and maybe try and bring in some other people as well and raise Fund 2 so you can keep pushing this vision forward. What will you pitch as the IRR performance of Fund 1? What will you say it is?
Well, we can't say yet, right? It's only 18 months in.
Yeah, but let's say you're raising your next fund. You have to somehow point to some amount of success in order to go out and get that next fund done. Usually it's a DPI or IRR metric.
Yeah, it's a good question. So this is something I wrote a memo and I share with my LPs about this, which is how do we measure our own performance? And it's actually quite challenging with what we're trying to do, because you're right. As a VC fund, because the fundraising cycle is 12 to 18 months, I may not have any cash returns, but hopefully, I've made some investments and they've been marked up by other VCs who've come in at a higher valuation, so I can quote unquote show that IRR right out of the gate. We can't do that because we had one fund that didn't have follow-on financing, but most of them are not even shooting for that, right? They're we're supposed to be, I call it first check, last check, right? We like to write the first check, and then their plan A is not to raise any more capital after that. So they're not really optimizing for that. So judging us on that doesn't make a lot of sense. The other thing is we're investing very early stage, and so using the kind of like terminal value, like we were just talking about, if you exit to a private equity buyer, that sort of thing, also doesn't make a ton of sense in the short term because they're not optimizing for profitability. They just raise some cash. They're probably investing it in hiring and stuff like that. So they're probably not super profitable in the near term. So basically all we did was essentially try to create some metrics and use some benchmarks around revenue growth and try to just, mark our companies according to that, right? We invested when they were at 3K MRR. Now they're at 30K MRR. It's obviously worth more. Our investment is worth more than it was when they were at 3K. It is actually a bit of an open question. And I think the only solution here is going to be a lot more funds eventually creating benchmarks around it in the same way that you can, basically create benchmarks among competing funds or funds in the same asset class over time.
Well, let's instead of talking about the general market, let's just be specific, right? I'm a massive fan. In fact, I have 4 new ones waiting for me right now of Yak, which is essentially like an audio version of Slack. They were one of your portfolio companies. I use it almost every day. It's very effective. Active Capital came in early this year in 2020 and in January and led a $1.3 million round. I assume, hopefully, at a cap or a markup more than what Earnest put money in earlier on. So 2 questions there. Do you convert? Does your equity convert at that point? Or do you still hold? Do they still have your agreement in place?
Yeah. Okay. So a couple of points of clarification there. So first of all, although we are quite focused on using the shared earnings agreement that we designed to align us with this particular type of founder, we are not that is not why we were here, right? We are here to back founders that we feel like match up with our strategy, which we call funding for bootstrappers and that sort of thing. And what that means is that not 100% of our deals are on exactly this shared earnings agreement. If we really want to do a deal, we will do a deal. It's probably a 90-10 split, but we will invest using other structures. We're not completely dogmatic about it, although obviously we tend to have a strong preference there. So in that case, we co-invested with BetaWorks and Boost VC, and so we used a more standard kind of venture terms with Yak.
And you just followed on there, or you led?
We followed. No, we followed. Yeah. So Yak is a bit anomalous for us. Essentially, I think I can share this. So basically, I wrote a post about remote tools for remote teams and why we were super interested in those kinds of products because, Earnest is completely distributed. Our mentor group is distributed. Our mentor group is like 40 software CEOs. Most of their companies are distributed. So I was like, hey, we know this space. We're a great place to beta test, to get the word out. Like, if you are building something in this space, you should come talk to me. And I got introduced to the folks at Yak, and they were pre-revenue at the time. They run So Friendly. It's an agency. This was kind of a skunkworks project for them. Had huge adoption as like a free open source kind of experiment, but was not a business yet. And I said, I love this. I completely want to invest as soon as you launch your paid product, and I can see some actual revenue traction, which is our model to invest, post revenue, and then. They got term sheets, right? And so I said, okay, well, we still love this. We want to invest, but 9 times out of 10, we do not invest pre-revenue. We invest in a shared earnings agreement, and we don't look for, follow-on venture rounds to mark up our investments. Yak is a exception to like all of those, basically.
Yeah. Okay, but that investment was out of the $3.1 million fund. It's the same vehicle.
Yes. Yeah.
Okay, got it.
Yeah.
So I want to be clear for everyone listening. I am now speculating, and everything we've talked about so far related to Yak is public. You can go see it on Crunchbase. They've written about it. It's all public. Now I'm speculating. A company like Yak, where you didn't, you did something different. You're 10%, and you put money in early, and then a firm like Active Capital does come in, and let's say it was at a higher valuation. Do you take that sort of increase in valuation and build that into how you think about IRR growth? Because that's even having another party come in and value it higher is better than you just saying it has more revenue, so it must be more valuable.
Yeah, it is. Yeah, so for sure.
Okay.
Like when they come in, I mean, we take the paper markup, we make it clear what's paper, what's cash,
Yep.
and so I mean, it's very hard when you're trying to do something, extremely new
Yep.
to then fit into the right boxes for LPs. And so the way that I try to compensate for that is writing incredibly verbose memos where I basically attack the problem from 7 different ways, publicly not publicly in this case, but transparently, and with the data being out there, rather than just kind of coming and saying like, oh look, yeah, we have a 60%, blah blah blah, that sort of thing. I just try to explain it and then say, interpret this as you will, essentially.
Yep.
Yeah.
Talk to me quickly about 1 second every day. That also looked like a co-investment. This is interesting. Yep. And that Indy was also involved. So one of my questions there was going to be, how on earth do your 2 term sheets work together? Because the models are very different. Does the founder have to pay both of them?
Yeah, so same deal. So out of the first 16 investments that we have done, 2 of them have not been on a shared earnings agreement.
I just hit the 2.
Yeah. So
of course.
Same deal. I met the founder, Caesar. I love the product. It was not a pre-revenue bet, by any means. Just awesome company, and it really checked all of our investment criteria. They're much further along than our typical investment would be. So when folks often try to talk about us in NDVC, the way I usually describe it is there's kind of like a Venn diagram of stage size. And we kind of overlap like just a bit here in the sense that we are very focused super early. We go up to like this kind of range up here. And in DBC, I mean, Bryce can speak for himself, but my interpretation is they're kind of more up here and they come down to just here. And there's this very small overlap, where that fits both of our models. And that's kind of what I felt about this deal, that it was, a good overlap for both models. And so we just co-invested on the NDVC terms.
Member Space also entered your program with fairly high revenue relative to the rest of the cohort. How did you convince them to take your terms?
How did I convince them? I don't know. I mean, I think, I'll speak broadly a little bit for a minute here, which is that, we definitely do offer at Earnest a real a bundled package, right? So there's capital, there is, community, there's shared resources, and there's mentorship. And the capital to me is much more the kind of glue that holds it all together, that keeps everyone aligned. It's one of the reasons why all of our mentors also have to be LPs in the fund. So they are actually like, everybody is invested literally in the success of the founders on this mission. And that is what binds together the shared resources, the community, the mentorship, all that sort of stuff. And so what we often find is that most of the founders do have a specific use case for the money, right? And there's a couple of inflection points that at various stages along the way to growth. There's kind of, okay, I need this money to quit my job and go full time or stop freelancing. So we write that check. It's, look, I need to make my first hire. I'm drowning in support tickets and all that sort of stuff. And we're just not growing fast enough right now that we can get, a support team and a QA engineer. So we want to do that now instead of in 6 months. And then we're trying to bring on some pros. Right? There's like, hey, look, we're kind of break even right now. We have our minimum viable team, and now we need to hire a serious senior engineer. We need to hire a serious marketer. We need to hire somebody, and we're getting above like the part-time junior folks and whatever, and we need to go out.
Your first $100K salary offer.
Exactly. And it's going to take us a while. And particularly, for example, if you're talking about something like marketing, where it's not just a salary, you also have to give them a budget to work with. Right. And so there's still this jump where it's like, we're profitable, we're good, we can keep growing through revenue, but actually we want to make these hires, we want to move to the next level. And we still feel like we need some upfront capital to get that done. Right. And so Member Space was more in that third category of like, they needed to bring on some pros, and the capital was there. But I think, if you ask them, and Ward, the CEO, has talked about this publicly, that like a huge part of their decision was just, feeling like they weren't going it alone, right? Feeling like they had a group of other founders, other mentors, the team, it's all that sort of stuff, behind them, incentivized to work with them and solve problems. And I think, when you pull the founders now in the portfolio, you say, how much do you value this, and this? The cash is like 2, 3, or 4, right?
Yeah.
And what's always number one is like working with other founders, and then the mentors are always up there, and all that sort of stuff.
And most importantly, you're helping these folks grow, right? I mean, Riley from Hostify has publicly put on his Twitter profile screenshots of his barometrics, so you can see that they went from 2K start to 24K now. He loves you guys. He thinks it's a really special thing to be working with you. So there are so many success stories here. Last question on this part of the fund. You say on the site sort of your average, and averages are dangerous, but your pilot fund check size was 50 to 250,000 usually, and you've been deploying with an average check size of about $150,000. You went a bit more aggressive with Endcrawl. I believe you were the only investor in the September 2019 round and put in 450 grand. Why so much? Why concentration risk?
That's not true. We led around with a bunch of angels. So
there were others there. Yeah.
Yeah, so this is something that we actually see a decent number of opportunities. We've done it 2 or 3 times, but a lot of times what happens is founders have a bunch of like industry angels, right? So they're not professional technology investors. They're not even really active, software angels, but they are in an industry. And in this case, it's B2B SaaS for the film industry. And so they're all kind of interested, but, when you start sending them, whatever, like safes, and you send them Brad Feld's blog and stuff like that, their kind of eyes glaze over and they don't know what any of this stuff means, and they're like, how do I get my money back? And they just don't get it. And then when they kind of read what we write, they're like, oh, this makes sense. I understand. This is how you back real businesses and get a real return out of it. And so what we have done and will continue to do is to lead rounds for these folks. So we just basically set the terms like a lead VC or something like that. We set the terms of the investment, and then they all just follow. In this case, we did a syndicate on AngelList or something like that.
And that's hugely valuable because you essentially lead, you do the majority around and give them incredible power to go close another 10, 20, 30 little checks from a bunch of strategic folks. It's highly valuable early stage. Yeah, very cool. Okay, let's switch. Last couple questions here, and then we're going to wrap up. So switching to LP management, again, because the way that these new models take off is you come up with a new model, and then you can make it work for the founders, and you can also make it work for the capital. So on the LP side, one of the things, so I know a lot of LPs and many funds. I know some LPs in indie VC as well. And one of the things they talk about is how important it is to try and use these instruments from a tax perspective and try and keep them as capital gains, right? The capital gain tax rate for LPs is obviously way more favorable than the income tax rate, which is where dividends come into play. Your thesis and Bryce's thesis and many of these new instruments look like equity for more than the required time period, which is a year, the first year, right? So that their taxes cap gains. And you're pretty confident you're not going to start getting dividend checks until way after a year anyway. In fact, Bryce's term sheets, you specifically says the repayment period doesn't start until after 12 years. To me, this strikes me more as catering to something that the LPs would like from a tax perspective than something that is necessarily 100% aligned with founders. What are your thoughts there?
I have a couple sort of disparate thoughts. First of all, I agree with our perspective on this is an equity-like instrument. I think that equity and debt is turning into more and more of a spectrum. The problem has been that there's been such a clear, bright line between equity and debt. It's this white space that a lot of folks are attacking, and so it's turning into more of a spectrum. One of the big consequences of are you debt or are you equity is the tax treatment, which is very, very different. I definitely believe, and we structure our terms, around the idea that this is equity risk, and so it should be treated, in the same way. For example, we don't ever strive to have any kind of covenants or any kind of way that we could. There's no deadline that you can miss for repayments, right? There's no way to default on us other than literally not making a payment that was sort of owed. But you know what I mean? Like you can't miss a payment, right? Because if the company's not profitable, you don't have the money to pay for it, then you can't miss a payment. So you can't default. So we can never foreclose on you and that sort of stuff. So it's very much equity risk. And so we do believe that, over time, this will continue to be categorized more and more as equity risk, which the tax code tends to reward with capital gains treatment. One of the things that I'm very straightforward with my LPs about is, hey, doing something new entails tax risk, right? A lot of just normal people don't know that there is no mechanism to go to the IRS and say, hey, I want to do this new thing. Here's exactly how it works. Can you please tell me?
Where's your intercom chat area where I can ask a question?
Like, can you tell me how you're going to, treat these taxes? There is no mechanism for that. Zero, none. Your options are you basically go to very, very expensive tax attorneys or big five accounting firms. You pay through the nose for their sort of opinion on what they think the IRS is going to do. You take your shot, you structure your deals, you start filing your taxes, you submit your tax return, and anytime in the next 5 to 10 years, the IRS can come back and say, we disagree, right?
Yeah.
And that's just a fundamental, like, irreducible risk of trying to do anything new. And it's something I have to be very straightforward with my LPs. It's like, look, we don't know how to, there's no way for us to reduce this risk to zero. We have hired tax attorneys to give us, kind of guidance on where they think this will lay down. But, this is something that actually in the energy industry where I started my career, there's a ton of experience with, because there's just an amazing amount of tax complexity because of the way that renewable energy is incentivized with tax credits. One of the first things I had to do in my job was to reverse engineer a bunch of really complicated financial structures called tax equity, where they try to take the tax benefits of a company and externalize them to a third party and all that sort of stuff. And the reality is, your holy grail for stuff like that is you operate in an area of tax risk for roughly 7 to 10 years. And then if you're really, really lucky, the IRS will finally say, here's our safe harbor guidelines, which say, yes, you may continue doing this. And if you would like to, get this tax treatment that we have been handing out, here's your sort of box that you need to sit in. But there's really no way to get that up front.
Yep. But what you're saying is, if you were controlling the IRS and you had a definitive say that you want this to be treated as equity, this is cap gains equity.
Yes, exactly. Yeah. And, we think it will. There's definitely open questions around the exact nature of the profit sharing piece, right? There's a whole spectrum.
I think by the law right now, it's like, and I'm speculating here to your point earlier, but as long as it's longer than 12 months where it looks like just equity and there are no returns of, DPI essentially on which would look like interest, then good to go.
Yeah, with a million asterisks that, I'm not a tax lawyer and ask your accountant and blah, blah, blah. Our opinion is this is equity risk. This is equity terms. It is long-term and it should be, taxed and treated accordingly.
Yeah. And just to make this really clear for anyone that just got super confused listening, right? If I'm an LP in Tyler's fund and he says, Nathan, congratulations, I've made you some money. Here's $100,000 check. If that comes in as a dividend because a founder has essentially paid back off the cash flow, as we talked about earlier, that would be taxed for me at something like 37-ish%, right? For accredited investors that have wealth, it's going to be 37-ish%. If that's taxed as cap gains, the cap gains tax is 20%. So that's the difference of Tyler, is a $100,000 check. If it's cap gains, right, I'm getting $80,000. If it's taxed as dividend or income, I'm getting $60,000. It's a $20,000 delta, which really impacts the returns of the profile. So this is a big question.
Yeah, and it's an important delineation, I think, for a lot more reasons than just tax, to do with risk and strategy and terms and all that sort of stuff, which is that there's a lot of innovation going on right now in different structures for how to provide capital to companies, right? A lot of people calling it like, VC alternatives and listing a whole bunch of them out. You've got a post as well, and it's great because it's like, hey, founders, here's a bunch of cool stuff. But from the perspective of an LP or an investor, et cetera, these can be very different, right? When you contrast like something like Clearbank or Lighter Capital, these are debt and debt-like instruments that are, have debt-like return profiles and debt-like tax treatment and all that sort of stuff, which is, I'm not even saying that's better or worse, right? I'm just saying like they are very different at the end of the day, even if from a founder perspective, they might be sort of just comparing and contrasting either of those. They end up with very different outcomes from an LP perspective.
Yeah, definitely. That is why, though, I'm asking all these questions, because like when you look at a Lighter Capital term sheet, right, their repayment cap is going to be somewhere between 1.4 and 2x. Your repayment cap is 3 to 4x. Now, that being said, there's way more optionality with your term sheet because that 3 to 4x return can come way over time. And oh, by the way, it may never come until the exit happens 10 years from now. So you are more patient capital than what Lighter Capital would be. But their effective interest rate, if you tried to compare these and actually tried to figure out an interest rate on a C, which is very difficult, by the way. But if you tried to compare, you could argue that if these facilities are paid off at the same point 4 or 5 years from now, that a seal is way more expensive than just taking straight debt, but less optionality.
Yeah, definitely. I mean, that's the principal trade-off of the entire, capital spectrum, right? From sort of corporate bonds to venture capital, right? I mean, how expensive was the check that went into Instagram, right? The effective APR on that has got to be 500,000% or something insane. But,
Yep.
It's a matter of also, it was 500K or whatever it was. And if they shut down the next year, they're going to write another 500K check, but if they're a debt firm, it's like, look, your credit is toast. We're never backing you ever again, right?
Yep.
I mean, there's different terms, different strategies, and all that sort of stuff, and that does boil down to a cost of capital that founders need to consider. But at a certain level, it becomes not apples to apples, essentially. Yeah.
Yep. Okay. Let's wrap up here. I want to give you a chance to talk about, though, your new model for your next fund. You've put out this great post, quarterly subscriptions to funds. So I assume that's how you're raising your next fund. Give us the teaser on that, then we'll wrap up.
Yeah. Basically, I mean, I sort of was thinking about. Well, the funny thing is, I'm constantly giving some of the kind of bootstrapper gospel to our founders, right? Stuff like, hey, don't be over reliant on one particular huge customer, right? You want to have a diversified customer base that, just all pays you in small increments, so you're never beholden to them, or, one customer defaulting can't, kill your business. And I would say things like, it's better to get to a break-even level of operation rather than being dependent on raising, more and more chunky rounds of capital to run your company, right? What you want to do is get your MRR up there. And then if you want to raise capital, like, great, but don't be dependent on it, right? I'm saying all this stuff, and then I'm running Earnest Capital in exactly the opposite way, right? I'm taking the traditional fund structure, which is very much like a huge part of the process. It's getting an anchor investor or one or two huge investors to say, yep, we're in. They make up the bulk of it. If they back out at the last second, you're totally screwed. It's absolute disaster for you. And at the same time, you're raising these chunky funds for, our first one was 18 months, but, we were going the traditional idea of let's raise for 3 or 4 or 5 years because, fundraising kind of sucks and it's not really fun. So I don't want to do it so often. So now I'm basically a venture-backed company, right? I'm basically going to raise my Series A and now my Series B, and that's going to get me, for the next couple of years, and that's going to set how I run this company. So this is not really how I want to run the company. And also, by the way, it's not really aligned with the folks that really want to back us. What we had was this sort of awesome flywheel of essentially entrepreneurs and angels and high net worth folks who deeply understood this industry, who read our essays and are like, hey, this is really cool. Like, how do I get involved? How do I support this? And we were sort of taking the traditional fundraising model and then saying, well, the way you do it is this way. And I know it doesn't make any sense for you, but this is how pension funds do it. So we're going to do it with you. Basically just said, okay, let's rethink this whole thing. How can we actually run a fund that makes sense, that runs like the way I tell founders to run companies, and also, by the way, is much more aligned with actual entrepreneurs, like people, essentially, as LPs. So the upshot is a quarterly subscription model. So the idea is, instead of me coming and saying, we're doing a 3-year fund, you need to put in $200,000. We'll call that over, the next 3 years. You don't have to put a $200K check in the bank right now, but you don't know exactly when we're going to make those calls, and you got to commit to the whole $200K up front right now. We say, actually, you're going to commit to a quarterly amount. We're going to call it, at the beginning of each quarter, and you need to make a minimum 4-quarter commitment. And then we also lowered our sort of minimum entry point to make it much more accessible to entrepreneur angels. And then we also decided, because I'm talking about this right now, we decided to make the fund a 506c fund, which basically means we can talk about it publicly. So what that turns into is just a flywheel of bringing on more and more, essentially entrepreneurs, the folks that frankly we really like working with, to continue backing the fund. And the last piece of the puzzle was we broke it down into sequential 1-year funds. And so what that means, so that combined with a couple other things means that we basically can accept new investors at any time. We do a quarterly call, you sign up for a 4-quarter commitment, and from here on out, literally any time, I don't have to put any time pressure on my LPs, which was my least favorite part of fundraising. I just say, look, if you're not ready now, we'll talk next quarter, or we'll talk next year, or whatever. But, at any point, you can just hop into the next quarter. join the fund, which has so far been really cool, actually.
Yeah. If you make 6 months from now an investment in this killer company, you have unique access to deal flow and it takes off like 3 years later, and everyone reads in TechCrunch that it has a massive exit. Aren't LPs going to be writing back going, wait, was I in the fund cohort that got the investment in that killer company? Like, that's why a lot of people do the fund structure, is to make it really clear what companies those LPs have exposure to.
It's 1 year funds, right? So it's, each year is a fund. And so it's pretty straightforward. Our investing pace is such that, we've been doing a deal a month, we will do more. And so, 1 year fund may still have, 18, 20 companies in it. And so that's a nice little portfolio. And if you invest during that period, you're in that fund.
What does it mean though? Like, so today, if you closed your first tranche of quarterly sort of people today, and then I say, you know what, I'm not ready now, I don't have enough liquidity, but let me start in the next quarter. So people that start today have 12 months, and then I start a quarter later and I have 12 months. But let's say you make an investment in month 13. So I would get it, but your people that started before me don't get it. Is that how that works?
I'm not sure I totally understood the example, but it's very clear cut. You sign up for a 4-quarter subscription, has to be equal weighted, right? So if it's, $10K a quarter, it's got to be $10K a quarter. Can't be, 100 now and then 10 for the next 3. And whatever fund is active at that time. So this is happening. Like July 1st is our first quarter. So July 1st to July 1st is a fund. Every dollar that gets called over those 4 quarters goes into one fund, and that's your allocation. So
so you're launching 4 funds every year, once a quarter?
No, one fund every year. Yeah. It's a 1 year fund, but there's 4 capital calls. That's it.
Okay. But if I don't invest in this first quarter and I pick up next quarter.
Yes.
And I commit to 4 quarters, I'm now off your annual cycle.
Yeah, so you'll have 3 commits that go into this fund and 1 that goes into the next fund. They just automatically set up year after year. Yeah. It does create an incentive to want to get in early, right? If you believe, because you have to do an equal weighted 4-quarter commit. So if you wait till the 4th quarter of the fund, you can't just dump a ton of money in, right?
Well, between you and I, as an LP who wants an index, I actually would avoid being only in one fund. I would purposely invest over the bridge, so I get half my money in one fund and half in another, because then I'm exposed to more companies. There's less risk.
Yeah, you could do that, or you could just do depends on, if you're hitting up against our minimum investment, which is it's $5K a quarter. So it's pretty low. For most accredited investors, you would just spread it out over the 2-year funds.
Got it.
But yeah, if you want to do it mid-cycle, fine. The whole point is to give more flexibility and optionality to investors, because we were basically treating them with the traditional model like professional capital allocators, whose job it is to take $1 billion and allocate it out, and they make a 3-year or 5-year commitment. Awesome, job done. And then it's somebody else's problem to provide the liquidity and cash flow management, all that sort of stuff. Entrepreneurs are I've got money now, but what if I have twins and want to buy a house a year from now, right? That may meaningfully change my capacity to commit to that. So we want to give them the optionality to say, that's fine. If every year you commit to 4 quarters, and every 4 quarters you have the capacity to, up, down, or 0, your ongoing commitment, essentially. So it's a lot more just it's SaaS, basically. It's a subscription, essentially.
Tyler, if people want to learn more about this, where can they go?
You can find me on Twitter at Tyler Tringas, earnestcapital.com, Earnest as in EARN, or not.vc, if that's easier to remember. That's where we're at.
Guys, there you have it. We touched on all the way back since Tyler in 2008, getting into the energy sector, then left the energy sector in 2011. Well, actually stayed in it, but launched his own company, SolarList, raised $400K into that product, learned about the downside of raising capital, and said, this little side project I'm building, which he built on a flight from San Francisco to Buenos Aires, ended up taking off in 2013, hit 2K in MRR. It was called StoreMapper, ultimately grew to way north of $18,000 per month in revenue, to the point where Tyler was able to take out $250,000 a year in free cash flow, travel the world with his wife, live a great, healthy, free life, and ultimately sold that company in 2017 before jumping in and saying, I want to help more entrepreneurs do what I just did via Earnest Capital. He's inventing a new way to fund these companies through a seal. His first fund was $3.1 million. They've invested in 16, about to be 17 companies. 40 LPs supported him in that. He's about to raise a new fund on a new model that more closely matches the sort of subscription model. You can submit every quarter and continue to support Earnest as a new asset class in the early stage B2B SaaS space. Tyler, thanks for taking us to the top, man.
That was an awesome summary. Amazing. Thanks so much for having me.
These CEOs rarely give these kinds of interviews. I hit them hard, I get the data, and I want to do it more. So if you want to get more of this stuff, make sure you subscribe up here. And then additionally, go check out one of my other CEO interviews right now.